Hi, Bill Henry, Robinson Henry. Today we're talking about income taxation of trusts. And I know what you're thinking. This is not a very sexy subject. But when I tell you you can save tens of thousands and not give all the money to the government, it becomes a little bit more interesting. All right, so let's jump right in. Okay, so first thing we can see here is we have an individual tax rate. We have a trust tax rate when we tax it to the beneficiary. And then we have a trust tax rate taxable to the trust. First thing we notice is that the individual tax rate is exactly the same as the trust tax rate when we tax it to the beneficiary, because we're taxing it to an individual. On the other hand, when we leave the money in the trust and it's taxable to the trust, almost immediately we hit the absolute highest marginal tax rate. And in fact, that happens at just $12,500. So very quickly, we're really seeing that we have all the highest tax rate taxable to the trust. Next, if we go a little bit deeper, as our income increases, just like we'd expect for individuals, we see that our tax increases. Well, what's the difference between when we tax it to the individual or in a trust, but taxable to the beneficiary versus making it taxable to the trust itself? Tens of thousands. So an enormous amount of money immediately. You can see that we can save if we have our trust taxable to the beneficiary. All right, so let's go even deeper than this. And let's say that we have a trust. And then what's the difference if we had a beneficiary of the trust that was married and we taxed it to that beneficiary, or if we taxed it to the trust? And let's say that trust made $300,000 of investment income, and that's all that this beneficiary made. First thing we can see is that that beneficiary being married gets a $2,400 standard deduction versus the trust, which gets $300 exemption. Taxable income, right out the gate's going to be less for that married couple, $276,000 versus about $299,000. That leaves us with a large disparity of income tax of $54,000 for the individual versus $109,000 for the trust. Massive, massive difference. So, of course, the government's not done there. On this interest income, there is a net investment income tax. Well, that tax hits the trust long before it hits the individuals. So that's a 3.8% tax, and that hits the trust whenever the income reaches $12,500. Well, we have $300,000 of income versus the individual hits the individual at $200,000 of income. Large disparity once again. Gives us our grand total, $58,389 for the individual in total tax liability versus if we tax it to the trust, $120,172 taxable to the trust. Massive difference. In fact, that would equal millions over the course of, say, 20 years if we just have some moderate compounding of that tax savings. So big, big difference. So let's talk for a second about first, what do we do about it? That raises the issue of, do we want to do anything about it? Well, why wouldn't we? If we're not worried about tax planning goals, and let's say, for example, we have a spendthrift child, or alternatively, we're doing some sort of Medicaid planning, or perhaps asset protection, we may want to retain that and take that tax hit. Also, of course, as the individual makes more and more money, the beneficiary of the trust makes more and more money, the gap between the total liability for the individual versus the trust, at least as a percentage basis, goes down. Something to bear in mind, of course, the trust will always be taxed more than the individual in terms of the total tax liability. Well, let's say we are worried about tax planning and we do want to save this money for ourselves and our beneficiaries. First thing to note is that if it's your trust and it is a revocable trust, then it is taxable to you. If you're alive and you put the money over to an irrevocable trust, then it potentially could be taxed to the trust. How do we avoid that? Well, the first thing we can do is we can keep a power back, a limited power of appointment, for example. And what that does is it doesn't create a gift into the irrevocable trust, meaning that it is an incomplete gift, therefore it is taxable to you. After you pass away, what happens? Well, the trust is irrevocable, or even if, let's say, during life you do put all that money into an irrevocable trust, you do not withhold any powers, and it is a completed gift. Do we have any solutions? Yes, we do. We can distribute the money to the beneficiary. When we distribute that money to the beneficiary, it is taxed at the beneficiary's tax rate. The great news is that for trusts, we can wait 65 days after the close of the taxable year to determine what makes the most sense in the individual circumstances, giving all the facts and circumstances we have. What does that mean in terms of how you draft your trust? Well, we want to, one, take in consideration your goals, and two, give as much flexibility as possible to the trustee in most circumstances that still, of course, meet your goals and avoid any sort of negative consequences that we don't want. Again, this is Bill Henry from Robinson Henry. Hope you enjoyed this, talking about income taxation of trusts.